All right. Matt the Mortgage Guy. In today's video, I'm going to walk through something I'm seeing more and more of. I'm sure you are too. These companies letting you know you can get money real quick, real fast, home equity. You don't even have to make payments. Is it too good to be true? Watch this video. I'll show you why it probably is. All right, Matt the Mortgage Guy, residential mortgage broker and homeowner advocate, trying to provide straightforward and honest information to help you not only get into the best loan product possible when you're buying a home or refinancing a home, but also help you avoid some of the stuff that's out there with trillions and trillions of home equity that people have amassed over the last few years. I'm seeing more and more companies get into the home equity financing game, right? This is the latest thing of it. I'm sure you're seeing some of it. I saw ads all over TikTok for home IPO. So what do? I go research it, and I'm going to create this video to hopefully provide you some insight into it, help you decipher. Because truth be told, when people read this stuff, they don't really know what they're getting into. I know this because I talked to folks who entered into equity share agreements in 2019, 20, and 21, and then called me to refinance. They had to pay off these equity share agreements to be able to refinance. And in a lot of cases, they were really, really misled or got themselves into a position where they had no idea what they had signed away when they originally did the agreement. You know, a lot of them, hundreds of thousands of dollars in equity. If I can help anybody avoid that, I'd be happy to. So I go to homeipo.org. And what I find out relatively quickly is that there's more than one company that's doing this. This homeipo.org is literally a landing page for a bunch of different companies. Now, real quick, just to explain what it is, you've got a home that's worth $550,000 and you only owe $300,000 on it. They're going to give you, they're going to say, we'll buy shares in your home, or we'll do an equity share agreement, whatever they call it. They're going to give you money in return for an ownership stake of your house, right? Maybe $50,000. And in return, they're going to tell you, well, you pay us back the 50 with a little bit of juice, right? It turns out it's a lot of juice. And I'll show you the real numbers, because what I did is I actually typed in a property that I personally own, put in an estimated value, and it spit out some numbers. So when you go here to get an estimate now, it brings you to 3 different companies, and you can get an estimate from these 3 different companies. I chose the first one, 458 reviews, right? Got to be good. I typed in a home value of $563,000. I want to use real numbers for people to understand what's going on here. And, had to put in my property address. I'm sure they've got some data that says how much debt I've got on it, or at least an estimate of it. Name, email, phone number. I'm sure they'll blow me up. They'll be fine. I'll talk to them, ask them a little bit more about it. But this home that I have, I don't know. I'm guessing it can be your primary or it can be a rental. Nonetheless, it was a rental. If it doesn't work, they'll let me know. Worth $563,000. Here's the interesting part. Congrats, Matt. We can get you up to $61,000, and in return, all we're going to ask is that original $61,000 you gave us plus 35% of your home's appreciation above $472,920. Okay, what's the big problem for me? $472,920 isn't the value that we agreed on today. The value that was plugged in and their automated estimator said this value was $563,000. So being pretty good at math like I am, I tried to figure out, where does this $472,920 come from? It's about 15% lower. I type in, 0.85 times my 563. That was a little off. 0.84. Voila. $472,920. 84% of what my house is worth today. So they take a 16% premium, and then they're going to want basically a third of anything it appraises for above that. Now that's interesting. Let's just, for example's sake, say it goes up 3 or 4% a year. It doesn't really appreciate a ton, but it's worth 600 a few years from now, and I want out of this agreement. We're going to have to take 600,000. I got my handy dandy calculator, minus the 472. And out of that 127,000, the funny part is it's appreciation above the 472. My house has only gone from 563 to 600. My house has really only gone up. What is that? Like 5%? But I'm giving them 35% of the appreciation above this number. Anyhow, 127 grand times 34.8%. I owe them 44,000 on top of my 61. So I'm paying them back 105 grand. That's not a good deal by any stretch of the imagination. What I will say to folks who need equity out of their homes for whatever reason, you have options. This is a quick way, an easy way, and a way that you don't have to make any payments. But in return for all that ease and for none of those payments, you give up a ton of equity. There's home equity lines of credit. There's closed-end seconds. There's cash out refinance. I understand when rates are in the fives and you've got a 2.75, a cash out refinance may not make sense, right? You've got to talk to a loan officer who can give you good advice to see if that makes sense or not. But you might owe 400 on your first, have it locked into a great interest rate, want to do a home equity line of credit for 40,000. No fees, no matter what the rate, you're never going to pay this amount. This amount is just absurd, right? The great part is there's the homeownership protection cap. We'll rake you over the coals. We won't make it burn too hot. We can only bust you for 40 grand in 3 years. Time passed from term start. Like, look at that. Like, they can with a straight face tell you, don't worry. Like we're putting a cap on how much we can really harm you to the tune of 41 grand. Where did I see this verbiage too? There was something on here that really cracked me up. Shared equity agreements. There was somewhere on here where it basically said we're on a mission to take power away from predatory loan companies. You are a predatory loan company. When you're charging people 15, 20, 25% to access their equity, that to me is predatory. So thanks for trying to protect us against you. Let's read their pros and cons. Pros, no monthly payments or debt. That's good. Large upfront payment, so you get the money. It's easy. Low credit scores accepted. I hope that they don't prey on low credit score people, because truth be told, I see it in FHA cash out. The data is clear. Companies like Rocket Mortgage are targeting people with sub 640 credit scores, folks that may not have as much financial education, and putting them in loans that don't make sense for them long term. Simple application process. Get your money quickly. You still own the house. This, to me, on their pros, is we make it fast. We make it easy. We don't ask a lot of questions. In return, we charge you ridiculous fees. There's a reason why I wouldn't ever recommend you get a payday loan, because you're going to pay 86% interest. Is it fast? Is it easy? Yes. Is it smart financially? Not even close, right? Let's see if they even know their own cons. If your home goes up in value, you'll miss out on some of your profit because the home IPO company you chose now owns part of the house. Well, no crap. They gave me 61 grand in that example, which on a 563 value is roughly 10%. And then they're taking 35% of appreciation, not off the value that they base it on today, but off of 84% of the value. So like the second you do it, they're taking 35% of what's already 16% equity. Like, because they're moving the needle. They're taking that 472 number, It's hard without, putting pen to paper, but 563 is the value I put in here. 472 is the number that they're taking home appreciation on. So whatever that difference is, 563 minus 472, 920, that's a $90,000 difference times 0.348. Literally the second you sign the agreement, they're entitled to $31,000 of your equity. That's bananas. That's crazy. That's 50% of the amount they gave you. You literally sign, and then 50% of what you signed for is due back to them. I'm sure in some wild example of theirs where it doesn't appreciate at all and you don't pay it back for 10 years, you get out for only 10% a year or something like that. But like, I can't imagine a world where this makes sense. I really can't. The more I think about it, the more I wrap my math brain around it, it's no bueno. It is no bueno with a capital N and a capital B. All right. I don't think I have much more to say about that. Please, in the comments, leave me your thoughts, your ideas, what you think of this, if you've come across other companies. Because like it says here, they say it, these shared equity agreements have been around for 15 years. Very few homeowners know how they work. The problem is homeowners sign up for them still not knowing how they work, just because when you look at the pros and cons, no monthly payments. They're easy to get. Man, this is not good. This is predatory. And they're on a mission to take power away from predatory loan companies. All right. Good luck with that mission. I don't like it. Prove me wrong. Tell me there's something good in here that I missed. I'd love to hear it, right? If you're looking to get pre-approved to buy a house or any of that stuff and talk to loan professionals that you can trust, who are out for your best interest in the long term, go to greatmortgagebroker.com. This was fun. Until next time, we gonna see.